So under investor education, we work across 4 broad heads. First is the investor education programs, wherein we hold classroom sessions as well as webinars conducted regularly, webinars such as the one we are holding today. So usually we conduct 2 webinars per week on different topics of securities markets. It's related to various regulations, to products, to financial planning, etc. Secondly, after investor education programs, an extension is that we are also having the CSR-based financial literacy programs, for which currently we have a tie-up with 6 organizations. These organizations are Kotak Securities, Geojit, Vivriti, Mirai, Aditya Birla Foundation, and SBI Capital Markets. So the objective behind this initiative is to take financial literacy to a wider audience. And through these initiatives, we have reached 28 states, around 380 plus cities and towns across India. We've covered 3,700 plus colleges, conducted nearly 6,000 programs, and impacted nearly 452,000 individuals. And the third initiative, which the Investor Education Department is handling, is the National Financial Literacy Quiz, which is a national level quiz for promoting financial literacy among the student fraternity, both undergraduate and postgraduate cohorts. And the idea is to catch them early. Like, we are just endeavoring to build the foundation of financial literacy so that they can make informed decisions as they are stepping into the financial world. The fourth initiative at NISM that we have is of masterclass series, which is curated and steered by our NISM director, Mr. Sashi Krishnan. He interacts with senior market experts and thought leaders who share their experiences, you can say investment philosophies and perspectives on the evolution of Indian securities market. So it extends to exchanges, depositories, the RTAs, a lot of work by custodians, FPI. There are too many areas that he's been covering. And all these recordings are available on the YouTube and on the NISM website under our investor education webinar icon. Other than the masterclass series and the above listed 4 initiatives, we also pursue various investor education advocacy initiatives such as Real Competition Ideathon for young student fraternity. And even for people at large, like whosoever is interested in securities markets and financial markets, so from time to time, we keep rolling such initiatives. So these efforts, as you would have, some of you would know also, like Ideathon, Reel Making Initiative, it reflects NISM's strong commitment to spreading investor awareness as well as promoting financial inclusion. So having said that, now let's move to the context of today's session, a very important topic indeed on derivatives. Now, just as a context, I would say that SEBI had conducted a study on the profit and loss patterns of individual traders in the equity derivative segment. And the findings have been quite revealing. To just share a few findings with you, it's nearly 90%, 90 to 91% of individual traders, they have incurred losses in equity derivative trading during financial year 2025. And this is a similar trend which was observed even in financial year 2024. The aggregate net losses of the individual traders have increased by 41% and has reached 1 trillion or rupees 1 lakh crore in financial year 2025, which is compared to 75,000 last year. So you can see the rate at which this has grown. Despite these numbers, the Indian markets continue to witness a very high level of trading in equity derivatives, especially index option, compared to even many global markets. So this is what the SEBI study is telling us. And recognizing this, the regulator has been introducing several measures from time to time to strengthen the risk management in derivatives. However, alongside these regulatory efforts, even advocacy efforts are very important. And that is why we have investor awareness and investor education webinars such as these. And they remain as one of the most effective tools to safeguard all our retail participants and help them make informed choices. So the endeavor is that you please understand the product before just, diving into it. Do not just be like getting the tips and just dive into anything. Like be an informed investor. So today with this background, it's my pleasure to invite Mr. Arup Mukherjee to take us through today's session. To just tell you a little bit about Mr. Arup Mukherjee, he has been the former MD and CEO of India International Clearing Corporation, which is a subsidiary of Bombay Stock Exchange located at the Gift City, Gujarat. Prior to this, he has worked at the BSC, that's the Bombay Stock Exchange, as well as the NSE, which is the National Stock Exchange, where he worked in various departments in leading roles. Overall, he has worked for nearly 4 decades with leading companies, particularly with the stock exchanges and clearing corporation. With this, I hand over the session to Mr. Mukherjee. So please take on forward from here. Thank you, sir.
Thank you very much. I just hope my screen is visible and I'm audible.
Yes,
So
sir.
I will start the session. So firstly, a very good afternoon to everyone who is listening to this webinar. And it is a very excellent initiative, of course, of NISM to have this kind of sessions and the various other programs which they have related to investor education, upgrading the skills of professionals and participants in the market. So it is very, very important to have as much knowledge as possible, because there are so many products which are there in the market today. So many, a plethora of products are available for investing today in the markets. And we know about these products. We have knowledge definitely about some of the aspects of the products. But sometimes our focus goes more into the returns. Like today we are talking about gold. Everybody's talking about gold and a little bit. Also, there is a lot of, news about silver. So we are talking about the returns of these. Mostly we say so much return, so much, the price was so much earlier. Now the price is so much, So the focus is on that mostly, and the retail participants, retail investors, they get attracted to this talk in the news and the media about the returns or the the increase in prices. But what we also need to focus on, if you want to become knowledgeable investors, is that there is risks also attached to each and every product. Whichever product we look at, apart from maybe the government securities, the government backed kind of assets, every product has got a risk in it, and we should focus on the risks aspect also, not just what appears in the media or in the channels talking about, so and so made so much money and this product prices has gone up. So that is basically my focus, because equity derivatives, particularly the index options, have become so huge in our markets, much bigger than the cash market and much larger than what it is in other markets of the world. Our equity derivatives market, particularly the index options, are so huge. Okay. Now that has also attracted a lot of retail participants into the market, and they have come in, and they trade quite actively, some with knowledge, some without knowledge. A lot of them probably would be without adequate understanding of the risks, because you see the SEBI studies have shown how many retail investors are making losses. Almost 90% of the retail investors are making losses in the equity derivatives market. So that shows that there is some amount of lack of knowledge or understanding about all the risks, and we just come into the market. There has been some drop after some recent changes. There are a number of retail investors have definitely reduced a bit, but maybe new retail investors are coming in, the other holders are going out. So as we go along, we'll know what is happening. But before we start, I would like to, the Diwali is coming close, and I would like to wish everybody in advance, have very happy Diwali to you and a prosperous New Year to you. And there is going to be a Muhurat trading session in Diwali today, this time. And this time the session is in the afternoon. So hopefully we have a big bang session in the markets, and we get a very robust and a very good market on that day. And when we talk about big bang or a bang, what do we think of? We think of the firecrackers. Okay, so some of us might be burning firecrackers, or mostly when we were children, we used to burn firecrackers. And firecrackers, they're enjoyable, they are fun to watch, fun to burn, but at the same time, they come with some amount of risk also. So we should be aware of the risks that come with the firecrackers, and then be careful when we are burning those, so that we don't burn our fingers. Similarly, I think the derivative products, because these are high risk products. You have various categories or hierarchy of products from lowest risk to the highest risk. I would put derivatives at somewhere in the highest risk kind of products. So these are also very risky products. So we must bear in mind the risk involved with the derivatives, just like the crackers have some risks. And we should be careful when we are burning crackers, when we are trading in derivatives, so that we don't incur losses, burn our fingers. So that is just a brief introduction to the topic, I would say. But as I go along the presentation, I would talk about the risks, not really the theoretical types of risks that we talk about: credit risk, liquidity risk, or settlement risk, and liquidity risk, so on and so forth. I'm not going to talk about the theoretical. I'll talk about one of the practical risks which investors or retail investors or traders they face when they trade in the markets. And my presentation is really not to discourage anyone from trading. You can, please go ahead, trade as much as you want, but just to highlight some of the risks attached in the derivatives market when it comes to the retail investors. When I'm talking about retail investors, again, of course, we know that investment is something which we talk about is a long-term thing, maybe 1 year, 2 year, 5 years. It could be up to 30, 40 years, doesn't matter. So there's a long term. It is mostly trading that happens in the derivatives market. But then there are retail investors, because the study of SEBI study has shown that among this 90% investors, retail investors or traders, whatever you call them, who have made losses, most of them had very low income. No, I won't say very low income level, but most of them were below 5 lakh income levels, 5 lakh per annum income levels. So you can understand the huge number of participants in the derivatives market who probably do not have that kind of capital, the abundant capital that you need, and you can, take those losses, take that kind of risk. So we have many small retail investors in the market. So while this presentation is not to discourage anybody, but just to bring some knowledge about the risk so that you become more aware when we are talking about a risky product like derivatives. And also, when we are talking about derivatives, we must understand one more thing. Just give me a minute. Yeah, just a minute, please. Just one second. Screen is not visible. Can you help me, Sahil?
Your screen is visible to us. It's not
Yes.
visible to you.
Yeah,
Wait.
how do I? Sorry, I got it. Okay, thanks.
Yeah.
So before trading any risky asset classes, I think it is better to understand all the associated risks, because once we understand these risks, then we can, we are on our way to becoming a better investor, a better trader in the market. So that is what the focus of this presentation is. Uh, you know, Okay. So we have read in the newspapers, there are many news reports which have come about, and which talk about the losses that retail investors are making. That nearly 91% of retail investors incurred net losses in the equity derivatives in financial year 2025. Okay, that's a report of SEBI. The report you can all refer to in the website. Also, retail investors lose 1 lakh crore in the financial year 25 on derivatives bets. That is another news report which, in fact, one of my cousins I was talking to, a few months ago. So she told me that, I stopped trading in derivatives, and I didn't even know she trades in derivatives, because she's a housewife. And I'm not saying housewives are not, smart enough, or they are definitely very, very smart to trade, but she's not the market savvy type. So I was wondering that why she was trading. So I asked her, why did you trade? Because she says, I stopped trading because I made a lot of losses. So I stopped trading. So I asked her, why did you start? Why did you begin? So she said that, if I knew that I will make losses and it is so risky, and I wouldn't have traded. So at that time it struck me that, whenever you open the trading terminal, the first message that comes to you is about the risk associated in the derivatives market. That, derivatives is risky. 9 out of 10 investors are losing money in derivatives. That is the opening, prompt that you get. And then in spite of all this information, still, if you get into this market and you make huge losses, and then you say, I did not know and I was not aware. So it sounds a little bit funny anyway. So that's why I thought I should also make a presentation and come up with it. So this is what it is. So retail investors losing huge amount of money, 1 lakh crore in the financial year 2025 on derivatives. One more thing
Hello.
which, yeah.
Sorry to interrupt you, sir, but your camera is off, sir.
Oh, okay. I think, is it okay? I mean, does it have to be on? I think
No,
I
not
did.
like that. Okay.
It's okay, no? Okay. So, also we have got news that, I mean, we have, no, people, some people we know who are, mainly youngsters who have left their jobs and they have become full-time traders and, derivative and the trading in the markets and trading in derivatives. That's also another aspect that, giving up maybe a secure job or, what should be your primary focus? The primary focus should be on our career, on our jobs, on our profession, and what we have, aimed to become. Like we have studied, we have got our graduation, post-graduation, professional college, whatever it is. And your focus should be more on that, and trading and investing and, markets, etc., should be a activity which is on the side, like we are doing it for building a corpus, building our wealth, etc. But I'm not saying that you cannot make a career. Full-time careers can definitely be built around trading and, investments, etc. But somehow a lot of people are, I believe, leaving jobs and full-time they're becoming traders, and they're also making a lot of, some of them are making a lot of losses. That's another aspect to this whole thing about derivatives trading. So a lot of losses retail investors have been making. SEBI studies have pointed out to so many retail investors, 91% of them making losses, and that has led to some concerns at the highest levels. And and that's why a lot of regulatory steps have been taken in the last few months, as you would all be aware of, particularly those who keep track of the derivatives markets and the regulation. So the increase in lot size in the in the equity indices, number of contracts which expire. Earlier every day some contract was expiring, that has been reduced. Now only you have 2 days of weekly expiry in the two different exchanges. Upfront collection of premium from option buyers has been made mandatory. Higher margin requirements on expiry date for open short position, so on and so forth. Daily monitoring of positions, removal of calendar spread benefit, which is to get on the last day expiry. So basically, many regulatory changes have been brought about primarily because the idea is that investors need some kind of investor protection is very, very important. So much of losses, it becomes really a systemic thing. When there is such huge losses borne by the retail investors, and the regulatory steps have been taken in the right path it is going. And however, the studies still show, and some of them are very recent, some of them are recent changes. So we will see the impact of this as we go along, as probably more studies come out from SEBI. But however, just a couple of few days back, another news report I saw, FNO trading continues to draw in retail investors despite SEBI flagging risk involved. And here's why. So whatever it is, so it still continues. Like FNO is still attracting a lot of retail investors. Numbers have definitely come down a bit, but a lot of investors are still there in the markets. And somehow this, the loss and investors still trading in spite of this loss is something of a dichotomy, but that still continues. Okay, so that is the purpose. My presentation is mainly focusing on the risks involved in the derivatives trading, equity derivatives trading mainly, and practical aspects of these risks, not mostly the theoretical side. So anyway, what is risk? We all know that risk is nothing but the probability of making a loss. So if I make an investment other than a completely government backed security, there is an element of risk in all these instruments. There is an element that I can make a loss if something goes wrong, and you're in an interconnected world, you all know. So something happening not only within the country but anywhere else also, anywhere in the world today, it has an impact on our securities market, and we can see those ups and downs in the market. And basically that is a risk for the volatility which is present in the market. But at the same time, it is studies have proved that if you hold an investment which is for a longer time duration, a very long time you hold an investment, then the probability of loss comes down. So if you're holding an equity share for 10 years, 20 years, or a much at a longer duration, then the chance of making a loss in that security or in that financial instrument comes down. That's what the studies show. Derivatives, however, are not long-term instruments. These are short-term products, short-term trading products. And there's a lot of trading that happens on the expiry dates of these contracts. When the contracts are about to expire, we find a lot of trading happening, speculative bets, you can call it, or just a prediction kind of where the markets will go, and based on that we're trading. So a lot of trading in the short term of few days in the expiry date, nearby expiry date, and on the expiry date is what is happening, and that increases the risks in the derivatives market. So that is why we say derivatives markets are a bit risky to trade in. Theoretically, there are a lot of studies of risk, and you can, as investors and as practitioners, you can read so much about risk, market risk, counterparty risk, liquidity risk, so on and so forth. There are so many types of risk, but these are all theoretical studies. So if I'm a student of derivatives, or if I'm a student of risk management, I can read so much about risks that are involved in different types of products and processes and all those things. So these are the theoretical aspects. But as investors, and me and you, who are putting in our money in the markets and trading in the markets, for us all the time to fall back on theories and to understand risk, etc., it's a good thing to do. But what we are impacted by is the practical risks which we face while trading in day to day in the markets. Whether it's derivatives, stocks, what are the practical risks that I face? And I should be aware of those risks. So I'm not talking about how we can manage those risks. Maybe a different exercise can be there on that. But my idea is that when there is so much of losses being made by retail investors, but still the retail investors are coming and participating in the market, are they aware of these kind of practical risks which investors face in the market? And that is what my presentation is going to be about for the next few minutes. So first risk is what, when you look at derivatives, and I'm talking about the retail investor, or I would say the retail trader, a person having a limited amount of money to put in the markets. I'm not talking about the experts or the sophisticated investors who have spent many years now in the markets, and they have got hang of all the the latest kind of tools and instruments which are there, and they use the charts, and they have become experts. My presentation is not focused on them. They have already mastered this, and probably if 91% are making losses, retail investors, that 9% who are making profits, they are having all this knowledge and information. It is not for them. It is mostly about the retail guys. So the retail guys, I don't know exactly, but my feeling is most of them could be just speculating in the market. And speculating means what? It is just my guesswork that today the markets will go high or today the markets will fall. So I buy a call or I buy a put, or whatever I do, sell a call, sell a put. I am doing just that. I'm taking a decision based on my understanding or of the prevalent market situation, whether it will move up or move down. So this prediction can come correct. I mean, you can make profits. Prediction comes correct, and you can make profit. But if the predictions go wrong, that can be a very, very risky strategy. So it all depends. So this speculation, as we call it, are based on tips, rumors, hype, etc., and these can sometimes lead to irrational decision making. Okay, so that is the first thing. Are you just a speculator? I am a speculator. I'm just buying, selling puts, and buying and selling calls and puts. If you're doing that, know the risks which are involved. Okay, so simply speculating, coming and buying a few calls or buying a few puts, it may lead to losses if the opposite of what you are thinking is going to happen. So are you a speculator? Then you are faced with lots of risk in the market. Then there are different strikes. So I'm not going, my presentation is not about explaining what is derivatives. I hope most of you are aware of what the product is as such. So as you all know, in the derivatives, you have got out of the money strikes, in the money strikes, at the money strikes. So many strikes are there. And out of the money strikes, as we know, are a little cheaper. And if you go deep out of the money, they are much, much cheaper. As deeper you go into the money, they're very, very cheap. So this out of the money strikes attract a lot of retail investors. And I'm sure if the study goes further into details, it will probably show that most of the losses may have arisen, I don't know, from the out of the money strikes which retail investors or traders would have brought. So there is an attraction for out of the money strikes because they are very, very cheap. At the same time, studies have shown that most of the out of the money strike options end in losses because they stay out of the money and they are never exercised. So the buyer never makes money. Okay, so I'm talking mostly from the buyer's point of view today. Maybe the seller's point of view, the seller would make money in this, and that could be among the 9% who are there in the market from the selling side. Okay, but anyway, if you're going for the out of the money, know the risks involved because they are cheap, they attract a lot of investors. However, if they go wrong, if your view goes wrong, then again you will face losses. So is speculating on the out of the money options worth it for the retail investors? Please, if you're a speculator speculating on out of the money, remember there is a lot of risk involved. Also, these contracts are not very liquid many of the time, so difficulty in exiting when you have the expiry coming and the prices are declining because of the time value issue, etc., theta issues. So you don't have time to exit also sometimes. So out of the money strikes can be risky contracts for you. So then what? So are ITM, that is in the money, at the money strikes, safe to trade in? Well, I would say yes. They could. I mean, studies have shown that mostly ITM, ATM may not 100%. There's no guarantee. May end up into profits, but again, it depends. It depends on the market as such, where the market is today. A small news somewhere, the markets can just go in the opposite direction by a huge percentage. Okay, so all these things can happen. So while ITM and ATM could lead to profit, they are again exposed to risk. So the trader or the investor should know that if the market moves in the opposite direction, they could lead to a loss, even that's an ITM or ATM strike you have traded in. If you are a seller on the other side, then you need a larger capital. You need a larger capital to be blocked when you're selling ITM, ATM. Again, you have margin calls which may come up when the markets fluctuate a lot. Even for buyer of these contracts, OTM is cheaper. ITM, ATM contracts are again, much more expensive to trade in. Much more larger margins are blocked. So all these things are there, whether you're a buyer or a seller in an ITM or an ATM contract. So again, expensive, and if you make losses in this, your losses would also be much higher. So again, something to be aware of. It's not that you should not trade in ITM, ATM, or OTM. It's not about that. But please be aware of these risks if you are a retail investor, particularly a person with not large amount of capital to trade or get himself exposed in the market. Then what about a very, very important concept, which is the time value of money, or rather the time decay of options. As we all know, there is something called as time decay or the theta impact on the options contract. So the options price is made up of the intrinsic value and the time value. Intrinsic value is the amount the options contract is in the money, and time value depends on how much time is left for expiry. As the option contract comes nearer and nearer to expiry, the time value reduces or the time value decays. And even if the option, even if your call is correct, like you have predicted the market will go up and the market moves up and you purchased a call, sometimes even if the market goes up, the call value does not go up because the time decay is so fast. You can see in this chart, as the options approach expiry, you can see the time decay, it falls down so fast. So the value of the option gets reduced or killed very, very fast when the expiry comes closer. So this is very important concept, which many retail investors will not be knowing about this concept of decay in the time value. So that this kind of information or this knowledge is very, very important if you're holding an options contract. There may not be enough time to exit the contract. You may be having very little time to exit the contract and the value may collapse. So, and there are certain strategies which can profit from this time decay. Also, there are credit spreads, calendar spreads, but even these are not 100% fail proof, and many retail investors may not be able to do these kind of strategies. They need some kind of expertise. So essentially what you need to understand that there is a concept called as time decay, which impacts the price of an option as they come closer to expiry, and this goes against the buyer of the option in a very big way. So the time can be essentially an enemy of that option buyer. So remember, this is another risk which is involved when you are trading in options, when you are buying options. That is the theta or the time decay of options. Okay. So we have covered a few things. If you're a speculator, there is a risk. If you're buying OTM options, cheaper, but again, there are risks involved because most of the OTM options end up worthless or they're not exercised, then ITM, the time decay of the option, something again an investor, retail investor should be aware of. Third, the next aspect is, this is also a very, very important aspect today. And we have heard certain news. I would not like to name any party over here, but we have been hearing news about certain very, very big, large players in the markets, and using very sophisticated tools and trading in the various, the cash market and the option derivatives markets, and all this news has been coming about. So who are these? These are basically the HFT players, the algo traders, or the quants, etc., who have emerged as the I would not say new, but emerged as very big players in the markets today. They have been there for some time now, but they have become very active now in the derivatives market. And these new ideas, today we have AI tools, etc., available, and so many other things are there. So they are coming up as the emerging kind of participants who use a lot of technology and a lot of modeling and statistics, etc., to trade in the market. And also they command huge resources. They have got huge amount of money to trade, to pump in the markets, to buy, sell, and do so many things across so many segments in the market. So you must remember that when you are a retail investor, a small retail investor, on the other side, who are the other participants? Yeah, there are many retail investors here we are also trading with, but these are the huge participants in the market who have got sophisticated tools with them, and they move in and out in large quantities, and they can buy and sell in such huge quantities, whereas we, the smaller players, are not really having that kind of ability. Our resources are limited, our strategies and our tools, etc., may not be up to that kind of level of sophistication. So, as a retail investors facing these kind of huge sophisticated players today, we could be at a disadvantage, and we could be outmaneuvered and outsmarted by this huge sophisticated institutional traders, HFTs, algo traders, etc., quants who are there in the market. So this is another aspect of the risk. There is no counterparty risk in terms of settlement that is concerned, because that is taken care of the clearing corporation and you will get your money, etc. Which I'm talking mainly about from the trading angle, the trading side, that you could be trading against certain players who are very, very large and sophisticated players. Now, as the studies have shown, and as I mentioned to you in the beginning, that 91% of the retail investors make losses, is what the studies have shown. Okay, so that means that 9% are making profits. 9% retail investors or retail traders are making profits, and you could be among them. So definitely you could be among those retail investors who are making profits, and congratulations if you're doing that. Okay, so retail investors do make profits, but the numbers, as you can see, is very, very small. Okay, 91 versus 9. So the chances of a retail investors making money is very, very small. And one more thing is that this I've heard from certain retail investors, also traders, etc., that they make profits in a few sessions or maybe few weeks, and then one large big loss, a large big movement in the market, and all their profits get nullified. So there is a chance, there's a possibility with all the market swings that happen nowadays, that one large amount of losses could just reduce all your profits in the previous weeks or months that you have made. So that is another issue, another problem that retail investors should keep in mind, that yes, I could be happy, I have learned certain strategies. So there are so many trainers and so many channels, etc., and I have seen so many of them, and best of luck to them if they are giving very good advice probably, and retail investors, everybody can learn from them. But it could be possible that you may have learned something and you apply those strategies, and then you make some profits in the beginning, but remember that one huge movement in the market can take away all the profits that you've made in the past. So outsized losses, which can erode all the profits in the past, can be another handicap which retail investors should be aware of, just like the other things that we have spoken of. And these are the practical aspects. I'm not talking about the theoretical things. Okay. Now, how about the strategies? We know that derivatives trading is just not about simply buying one contract, and just like you buy one share in a day probably, and you say, okay, fine, now I'll make money out of this, etc. Derivatives involve strategies, because these are non-linear trades, as we all know. These are non-linear payoff diagrams and all that, if you know. So you can combine trades, you can combine different strikes, or different expiry days, calendar spread, strangle, straddle, collars, etc. You can certainly try and take advantage of the market movement. So the market moves on any side, higher, lower, still I will make money. Or if the markets don't go anywhere, I do a short straddle, etc. There are so many ways you can profit from the market movements by doing various strategies. Okay. However, you must also remember that none of these strategies say that it's 100% foolproof, that you will not make any losses. No. If the market stays in the range that the strategy talks about, or whatever it is, you will make a profit. But there is always a chance that it could also lead to losses. There is always a chance. So when you do the strategies as a retail investor or whoever it is, you must understand the strategies very, very well. You must understand how to do these strategies and execute them properly, exit the strategies whenever the time arrives for exiting, and then probably you will make money. Otherwise, for a common man, for a common retail investor, I don't know how many of us are able to do these strategies at the right time, with the right amounts and exit or whatever it is. But if you can do it, excellent. But then remember that not all strategies, these strategies also have some amount of losses, tail end losses, you could call them. And also there could be chances that you make profits from these strategies for the first few months, and then a large movement and all the money gets wiped out. This is also possible. So I'm not denying that some of these strategies are very, very good and you can definitely make money, but you have to become expert, or you have to learn, go through that learning curve, and then probably gain the expertise, and then you can implement the strategies. But they do not come with 100% guarantee. No trade, no transaction probably can give you 100% guarantee, is what my feeling is. So there are risks involved, even if you apply these kind of spreads and other types of strategies. Okay. Then we all know that derivatives is a leveraged product. Okay, so you do not have to pay the full cost when you're trading. You pay only the part of the money, and you get a large position in the market. So you control a much larger position because of this leverage. So in a cash market, you have to pay entire 5 lakh or whatever, 1 lakh, whatever it is. But here you can pay only a percentage of the overall transaction, and that attracts a lot of investors, a lot of traders into the derivatives market. Some of them even borrow money. They think that, okay, I'll pay return the capital with the interest, but still I will make profit. So people end up into borrowings also while trading in derivatives. So you are committed. So, we are committing a large amount of money in trading in these contracts. And, people get attracted because the position that you take is much larger. But do remember, this leverage trading also comes with a risk. If the markets fluctuate too much, you will be called for further margins and, further payments you need to make. And also there have been certain recent changes which have increased the costs of trading a little bit, because the lot size have changed, margins have gone up. So you should be aware of all these kind of aspects, that there is no free lunch, as we can say. So the leverage trading comes with its own risks. So if you're a person with a limited capital and you get attracted to this kind of market because you would say that I will deploy my limited capital and get a huge leverage out of that limited capital, but there's a risk also along with that. If your view goes wrong, the entire transaction then will fail and you can lose all your money. So leverage trading, increased cost of trading due to certain regulatory changes, etc., can also lead to large losses, which retail investors may not be able to cope up with. Okay. Then there are regulatory changes which have been brought about, which I kept mentioning. The regulator's primary focus, as we all know, is on investor education, investor protection, and then the investor education seminars and all these things which are being conducted to increase the knowledge levels of the investors. So through judicious rules and regulations, the regulator carries out these tasks of investor protection, development of the market, keeping financial systems safe and secure. So we must be aware of all these regulatory changes, taxation changes, as a retail investors, because these also impact our decisions, impact our trading positions, and how we are trading in the market, etc., etc. So all these significant changes which have come about in the derivatives market should be known to retail investors, so that you base your trades, or you change your trades according to these regulatory changes which have come about. So these are some of the practical kind of things that I wanted to focus on when you are trading as a small retail investor in the market. As I told you, my primary intention of this presentation was to talk about the real aspects, the real risk that you face. trading in OTM options, trading in ATM, ITM, speculator in the market, facing such sophisticated players in the market, which you have heard so much of news in the past few months we have been hearing, sophisticated players in the market, leverage trading, borrowing for trading. All these aspects are very, very important when you are stepping into the derivatives market and you are getting attracted by these markets from the kind of, the noise in the market or the noise in the YouTube channels and, so many other things, the training, the programs, etc., etc. But remember these aspects, and with a small capital that we have in our disposal, are we able to face these kind of losses? Okay, so like this chart clearly showing, this is taken from a comparative study of growth in equity derivatives market vis-a-vis cash market by SEBI, published on July 7, 2025. And you can see the losses around in the financial year 2025, 5,603 crores losses have been made by the individual traders and individual retail investors, whatever you can call them. Okay, so 96 lakh people, and so huge losses have been have been there in the market, which are reflected in the studies. So it is ultimately a zero-sum game. So for every loser, there is a gainer. Options market, we say the losses can be limited because the buyer pays only the premium and you can lose maximum the premium. Again, for so many reasons, as I showed you, the risk that you are facing, you may again lose, and you are just passing on, you're just giving away that money to some other trader or other participant. And there are sophisticated traders who are better at exploiting this market, exploiting the advantages in the market. So as a combination of all these factors, the retail investors are losing out. Studies have clearly shown that. And when you step in, when you come into these markets, please be aware of all these practical risks that you're facing if you're a speculator or if you are trading in the market, doing strategies, because it's a zero-sum game ultimately. So it is better to be informed, knowledgeable, and educated investor or trader to make sure you understand all the risks. It is not just about the returns. It is not just about the the kind of what you hear or what you see today with all the channels, etc., etc. But be aware of the risks that you're facing, the limited capital that you have, and the exposure that you're taking in the market. So we talked about so many types of risks, not the theoretical, not the credit risk, liquidity risk, settlement risk, and all the other theoretical. You can definitely do a study on that if you're a student of the markets. But the general, the speculative risk, trading in OTM, ATM, ITM contracts, time decay risk, sophisticated counterparties, outsized losses, which can erode all your past profits, leverage trading, zero-sum regulatory. So you should be aware of all these risks and understand this, analyze all these risks that you're taking, and then actively participate. Idea is not to discourage anybody from trading in the markets. Please go ahead, use these contracts. These contracts are mainly, when the derivatives market started many hundreds of years ago, it was mainly for hedging. It was for risk management, but definitely without speculators, arbitrageurs, the markets are never going to be complete markets. So there is a very big role arbitrageurs, speculators, arbitrageurs also play along with the hedgers in the market. But as retail investors, I'm a salaried man. My focus is on my job, how well I can do in my job, grow in my job, earn a higher and higher amount of income from my job that I'm doing. My focus should be on that, how I grow in my skills, how I develop my skills, and how I grow in my organization, or if I'm doing business also, if I'm into business, how I grow my business, etc., etc. That amount of money that I'm earning, should I put it into and put that money into risk, and how much risk also is something each individual has to apply his mind and take the decision. That is not for anybody to decide, but know and be aware of all the risks, particularly the risk in the derivatives market, which I focused on today when I made this presentation, and then decide what is your objective. Do you want to be a trader who pumps in money, puts in money, is a hard-earned salary or from the business income into equity derivatives, or you want to be a long-term wealth creator? You want to stay invested in products like the equities, mutual funds, ETFs, whatever they are, and stay invested for as long as possible, maybe till your retirement or whatever it is. and be a long-term wealth creator. Buy a basket of stocks or a basket of mutual funds, a diversified basket of mutual funds or stocks, and hold them as long as possible. And that way also you will create wealth. So we get attracted to financial products like derivatives or other products, gold, or whatever it is, thinking that I will make money, quick money, etc. It can happen. There is a risk involved, which we talked about today. So your objective is what? To take this kind of risk and stay and become an expert slowly and steadily, or have a long-term view that in the long term I will grow my wealth. In the meantime, I focus on what I'm good at, which is my job, which is my career, and what I've learned out my business. And I put some money, of course, in the derivatives markets and trade also, but depending on my risk-taking ability. That is very, very important, my risk-taking ability. Okay. So that is what the focus of this presentation is. Purpose of this presentation is just to highlight some of the risk aspects, which is given over here on the left, all the risks that a retail investors practically faces when they are trading. And it is not to persuade or discourage any retail investors that do not trade in the market, do not trade in derivatives. Go ahead, but gain as much knowledge as you can, gain as much knowledge or understanding about the risks that you can. And it is, after all, your choice, because it is your money, your profits, your decision. And so you can please go ahead, trade as much as you want, as actively as you want. But do remember the SEBI studies. Go through those studies if you have not read those studies. So what is the impact of all these risks that a retail investor can face when they're buying calls, puts, or whether doing strategies, which are, plenty of the strategies which are there. Do remember these risks, and then you can decide what you want to do: trade actively or trade occasionally, or lesser amount of capital you deploy in the derivatives market, or become a long-term investor, having a basket of stocks, diversified stocks, mutual funds, etc., etc. After all, it's all your decision. This is just an investor education seminar where I try to highlight some of the practical risks which any investor would face in the markets, and that is what the main purpose is. So with this, I complete my session, and I thank all of you for your patient hearing. And again, once again, advance happy Diwali to all of you. And I hope I have been able to throw some light on the practical risks that are faced while trading in derivatives market for small retail investors with limited amount of capital that we have with us. And that is the purpose of the presentation. And now I throw it open to question and answer, or NISM can take it over. Thank you very much for your patient hearing.
Now I request the participants to ask their questions in Q&A section so that sir could answer it. Hello, sir.
Yeah,
There is one question in Q&A section. Okay.
yeah. Oh, there is one. If an individual wants to be a SEBI registered technical analyst, which certification he should pursue? I think I will leave it to somebody from NISM, that there are so many NISM certifications. Yeah, Sahil or Rasmeet, somebody is there.
Yes, sir.
So there is a question: if an individual wants to be a SEBI registered technical analyst, which certification he should pursue?
So they can visit actually NISM website so that
Okay, okay.
they can
I think what you
have
can
the
do is you
detailed
can
information.
yeah, I think you can search as NISM certifications, and there are a lot of certifications which are, really very, very good certifications. You can see those certifications, and among that you can choose whichever you want to, for your skill set.
Yes, and so just to add, as a research analyst certification, but please read the SEBI communique and the NISM communique, the mandate for what it is required, the curriculum and all that. So it's a research analyst now. There is like exclusively for technical analysts, there is nothing. But for research, there's a research analyst certification. So please go through the details and we'll just send that thing on the chat also, the link where you can read it up.
So there is one question, risk is everywhere, options or stocks. What is difference? Yeah, so that's what I tried to explain. Options are short-term contracts, so they will expire within a week or within a month or quarter, etc. So they're short-term contracts. For whether when if it's a stock, you can buy and hold that stock for a much longer duration, and the longer that you can hold the stock, the probability of risk then reduces. So the returns possibilities increase if you are able to hold an investment for a much longer time. Does not mean that every stock if you hold it for a very long time, you're going to get returns, because some stocks may not give you returns, they may die out. But the probability is that if you hold some basket of stocks or good, some good quality stocks, the return would be there. So I would say the risk is a little lower chances of risk in stocks, because if you are able to hold it for a longer time, the risk get reduced. Then kindly throw some light on IV, implied volatility. So this is again implied volatility. There are strategies for that, vol strategy, straddles, triangle, etc. So you need to study these strategies and become an expert. So the volatility means market can go up, market can go down. So you can do a straddle or you can do a triangle. So the market goes up and doesn't breach certain level, you can still make money. So there are such strategies which you again need to study, these kind of strategies, implied volatility and all that. You can probably there can be a separate session from somebody on all these strategies and how you can make money out of these strategies. Then how can low liquidity in a contract increase my losses, and how can I tell if a contract is liquid enough? I did not understand how can a low liquidity in a contract. Low liquidity in a contract can increase your losses, because supposing there is low liquidity, you want to, now you're seeing that you purchased a call and the price of that call is coming down for time decay or whatever reason it is, and now you want to exit that contract. Sometimes what can happen is, as the time to expire is coming, lot of players will move out of the market. So they will be on the other side, they may not be anybody for you to move out. So if the liquidity is low, you cannot exit that contract easily, and you can face certain losses. And you can know the liquidity by looking at the options chain. There's something called the options chain. The entire picture of the options contracts is visible on that options chain. So if you go to NSE's website, BSE's website, or you can just do a query options chain in Nifty or Sensex, you will get that. You can know the liquidity from those contracts. Of course, your trading terminal gives you the entire liquidity in the contract, and that way you can know. Okay, then how to minimize loss? What is a period? How to minimize loss? What is a period for learn? So how to minimize loss is something very difficult for me to tell you. This is something which you maybe from your experience, as you gain experience, and how much time it takes to learn also is very difficult to say. Some people may learn it in few months, years. We don't know. So I cannot tell how much time it will take to learn derivatives and become a master in it. But you can certainly try your luck, start trading in small ways and see what happens and then learn. Not possible for me to predict, tell you how much time it will take. Which option asset can be considered to hedge risk? Yeah, options are for hedging risk. So which asset class can be considered to hedge the risk involved in options? So if you feel the markets are going to drop, you can buy a put option. So if you buy a put option, then the markets drop, your put becomes valuable. So that is one of the strategies commonly employed by retail investors when the markets are dropping. You buy a put option, and then you can, if the markets fall, you can the put will be, giving you returns. Or you can sell a call also. By selling a call, also if the market drops, you keep the money with you. The premium that you have received, you keep the money with you, and that can again give you return. So just one small thing. That, see, my objective here was not to explain derivatives. I think there are some other classes which are there. Earlier I've seen where they talk about how to hedge and all these things. So my purpose was mainly on the risk side, because if I have to talk about how to trade, etc., that would be a completely a new session. Can you please recommend some of the good books that you have read in the past? Okay, so for me, the book that I read in the past and which I continue to read is John Hull. So I started my career ages ago, and John Hull was one of the best authors in those days also. And today also he continues to upgrade the edition that we have. So I rely on the John Hull, the book, derivatives book. And if you read that, little complex on some of the aspects, but really good book is John Hull. Okay. Which asset class can be considered to hedge the risk involved in option? I think I've already covered, buying a put or selling a call. What is the purpose of derivatives in equities? Yeah, so that is what it is. That is what I told, that derivatives mainly the purpose is risk management, hedging. If the market price drops in future, I have a derivative contract. I can buy a future, or I can buy a put, etc. And I can hedge myself, or I can prevent my risks. So main purpose of derivatives is hedging or risk management when it evolved in the beginning, and after that hedgers came, what you call the arbitragers came, speculators came, and now it's become a very, very sophisticated market. Again, a separate session would be required on these aspects, like what is the purpose of derivatives, how do you hedge, how do you do arbitrage, how do you do speculating in the markets, etc., etc. That's a separate thing. What is the purpose to do hedging in stocks? Hedging means risk management. Hedging itself is risk. You have purchased a basket of stocks. Now the markets may drop. Okay, if the markets drop, as you are aware, if the markets drop, stock prices also drop. Okay, because of the the overall risk involved in the market, the stock prices may drop. So for that, you need to hedge yourself. You need to protect yourself against that risk, and for that you can short futures, you can go and sell futures, or you can go and buy puts in the market. Same thing, selling futures or buying puts, and if the market drops, you gain on the futures or you gain on the puts, and that compensates for the loss that you made in the stocks. That is the main purpose, or that is the main way that you do hedging. Again, separate session, I think, is required. I think that is most of the questions I can see, unless there are more. What career opportunities that you can expect? So this is again a question which probably somebody else would be better qualified to answer, but definitely if you are specializing in finance, if you're doing your CFA or FRM or MBA, whatever it is, there are many, many areas today which are opened, or which have opened up for derivatives traders, for quants, for this kind of investment analyst. So many career options are there today, definitely in the finance market, which are connected to derivatives, connected to investments, etc., etc. Which good YouTube channel do you? Oh, a YouTube channel I cannot comment on. I'm sorry. Then anything else? I think I've answered all the questions. Please help to get the percentage of investors who do hedges out of 21. Ideally, it should be not be 91% investors. Accordingly, it should be less than 91. Okay. So there's a question saying that the investors who are making losses is shown as 91% in the study. How many are actually doing hedging? So hedgers should not be making any losses, is what it is. The question is saying. Ideally, yes, hedgers should not be making any losses, but how many retail investors are actually coming into the markets to do hedging? That is the question. Most of the retail investors, my belief is that would just be coming and speculating in the market. They are the speculator category, not the hedgers category. Most of them is what I feel. I don't know. Maybe studies will reveal that. And because of that speculation in the market and what I covered today, the OTM contract and the ITM and the sophisticated players on the other side, time decay, etc., which retail investors may not be so much aware of. Because of that, probably the losses are being faced by them. But how many are doing hedging? I have no idea as of now. How to learn? Is there videos from NISM, SEBI, etc., etc.? Yeah, there are many videos on the YouTube channels. There are so many videos. You just need to do a query, learn options, learn futures, learn strategies. Everything is available to you at your fingertips. There is no dearth of knowledge when it comes to derivatives, investment strategies, even modeling, and most sophisticated things today you can learn just sitting at your home from all the channels and all the available the material available on the websites. Okay, NISM has got some very beautiful, very, very nice courses which you can visit NISM site, and you can definitely go through those courses, and you can equip yourself and become an informed investor or make a career out of the opportunities that are there for people who have good knowledge about the markets. I think that is all the questions. I don't think there are any more questions I can see. Yes, Sahil or Rashmi?
Yes, sir.
Thank you so much,
I,
sir, for the session. So it was quite an insightful one. And with this, I think we can conclude the session. And thank you to all the participants. And as sir mentioned, NISM provides a lot of certification programs, training programs, as well as e-learnings and skill development programs. So kindly visit our website for all the details. And there are some toll-free numbers, the emails, email IDs provided. You can write your query on those numbers also. Thank you so much. With this, we wind up
thank,
the session, sir.